is about looking for indication from the Fed that it is serious in wanting to contain inflation, bring it back to 2, and it has to move, some say, has to get it by at least 4% by year end. I mean, has that been factored in when you take a look at current levels?
Not quite. If you look at 2-year yields, they're about 3.7%. So there's a little bit more to go. But as we've seen, even 10, 20 basis points moving higher is painful for markets in repricing that. So there's a bit more work to do.
What's your own assumption? Are you looking at 4.5%? We heard from Ray Dalio. He says it's going to be 4.5%, and that means a 20% decline in stocks.
Yeah, if you look at a 4.5%, that presumes the Fed is successful at getting inflation down to about 2.5% next year. And so in a sense, that is putting a lot of credence into the Fed policy. They look committed. The market believes they're committed. But any type of inflation shock beyond that means even 4.5% is going to be still a bit low.
So nowhere to run, nowhere to hide. The dollar is the only game in town.
Well, a strong dollar we think is very much intact, but you're seeing, as you talked about, the Bank of Japan is going to try and start leaning against that. The ECB is starting to pick up their pace in terms of tightening, and so you're going to see much more volatility and a tug of war in currency markets, and the risk for investors is a market FX, which has been very low volatility, is now going to be very high volatility going forward.
Okay, let's say this MLive question that we have, Norman, the MLive Pulse question, and it is, what is the best trade ahead of that meeting of the Federal Reserve next week?
Well, we think a good trade, again, we talked about FX, is being short sterling from here. We think there's a limit to how much the Bank of England can fight inflation given what's happening in their domestic economy. The Fed is committed, and so the risk is you see sterling moving towards parity over the months ahead.
There we go, and that is the Pulse question. We've got another question for you as well, and that is regards to the inversion of the yield curve. What is this telling you? Because, I mean, between 2s and 30s, we haven't had this level, this depth of inversion take place this century. I know we're 22 years only into it, but it is instructive. Does it more or less cement a recession?
We think it does signal recession in 2023 from here. And I know you're highlighting, okay, this is the deepest inversion we've seen this century. If you look at the last time we've seen inflation like we're seeing today in the 1970s, the inversion was as much as 100 to 200 basis points deep. And so if that's the case, there's still a bit more work to do even on that front.
Should you be cautious on China? I mean, there's so much optimism that post-Party Congress in October we'll see stimulus, but, you know, China's been pretty conservative when it comes to stimulus. I mean, and if you are optimistic, what would you be buying?
On an absolute basis, we're cautious not only on China, but on equities in general. On a relative basis, China's one of the only places in the world that is leaning against slowdown and actually trying to incrementally ease. We think that's a positive from here. They're very much focused on being targeted in terms of how they provide that stimulus. So we want to be very domestic focused, be a stock picker in China from here. And we think that stimulus and that support picks up marginally as we go post-Congress in October and November.
Norman, just a quick one on what you're calling market dysfunction since 1980. What's your thesis?
So if you look back since 1980, you have these prolonged Fed rate hiking cycles. Invariably, what follows is some structural breakdowns in markets, whether that's a credit problem, we saw that in 1997, 1998, or if that's some dysfunction, as I like to describe it, like we saw in 2019 in the repo markets, that cause instability and force the Fed to pause and sometimes actually completely pivot. So that's something we're watching for, because that'll be an important trigger for Fed policy as well.